Today, I want to discuss a hidden risk associated with investing in SoFi stock. This isn't meant to discourage anyone from considering SoFi as an investment, but rather to ensure you're fully informed about the potential downsides. It's always crucial to weigh the risks against the potential rewards when making any investment decision.
Hello, everyone.
Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. First off, let me clarify that I still rate SoFi stock as a buy. However, even for stocks that I recommend, it's essential to examine the bear case scenario, the worst case scenario, so that you're aware of the risks involved. Investing always involves a balance of risk and return, and it's important to evaluate whether the potential upside is worth the potential downside. Now, let's dive into the specific risk I'm talking about. The primary risk with SoFi revolves around its exposure to loans. To fully understand this, let's first look at how SoFi positions itself. SoFi proudly claims that their customers have high credit scores. For instance, they state that their personal loan borrowers have an average income of $169,000 and a weighted average FICO score of 746. They provide this information to assure investors that their lending practices are prudent and that they are targeting high-quality borrowers. This is true to an extent, as data shows they are indeed selective with their lending. So, what happens to those applicants who don't meet SoFi's criteria? SoFi has a strategy for monetizing those rejected applications by referring them to other lenders who might be more willing to take on higher-risk borrowers. This way, SoFi retains the best quality borrowers for itself. For example, their student loan borrowers have an average income of $146,000 and a FICO score of 768. While this might seem like a better risk profile, it's a bit misleading because student loan borrowers are typically younger with shorter credit histories. This makes it harder to gauge their reliability in economic downturns compared to older borrowers with more established credit histories. Now, let's get into the core of the issue. When SoFi issues loans, they have two choices: keep the loans on their balance sheet or sell them to other investors. Keeping the loans means SoFi is exposed to the risk of delinquency. If borrowers default, SoFi absorbs the loss. Alternatively, SoFi can sell the loans, thereby transferring the risk to the buyer while recouping the loaned amount and earning a fee for the service. In the last quarter alone, SoFi sold over $1.9 billion worth of loans, including $126 billion in personal loans, $300 million in student loans, and $350 million in home loans. Personal loans are the riskiest of these categories. If borrowers face financial difficulties, personal loans are often the first to default. Borrowers will prioritize keeping up with mortgage and car payments to avoid repossession of their homes and vehicles. Personal loans, on the other hand, only impact credit scores upon default, making them less critical to borrowers. Given this, it's understandable why SoFi sold a significant portion of personal loans. They want to mitigate their risk exposure. These personal loan sales typically involve selling at a premium. For instance, if the nominal value of loans sold was $500 million, they might sell them for $557 million, earning a small profit. Investors are willing to pay this premium for a couple of reasons. They don't have to go through the effort of originating the loans themselves, and SoFi offers to handle the servicing of these loans, including collecting payments for a fee. Here's where the hidden risk comes in. Despite selling these loans, SoFi often includes a loss share provision in the sale agreements. This means that if the sold loans default, SoFi is still partially on the hook for the losses. This provision undermines the notion that SoFi completely offloads the risk when they sell the loans. Essentially, SoFi retains some exposure to potential losses, even after the loans are sold. This loss share provision could have significant implications for SoFi if there is a substantial number of defaults in their personal loan portfolio. Not only would SoFi have to deal with losses from loans they still hold, but they would also have to compensate investors for defaults on the sold loans. This could have a considerable impact on SoFi's financial health. It's important for investors to be aware of this hidden risk. While SoFi's strategy of selling loans with a loss share provision might help them manage short-term risk and generate immediate revenue, it also leaves them vulnerable to future defaults. This potential liability is something investors should keep in mind when considering the long-term prospects of SoFi stock. To reiterate, my intention isn't to scare you away from SoFi stock. Despite this risk, I still believe the stock has significant upside potential, which is why I continue to rate it as a buy. I updated my recommendation as recently as May 13th. However, I believe in making investment decisions with a full understanding of both the potential rewards and risks. By being aware of this hidden risk, you can make a more informed decision about whether SoFi stock is the right investment for you. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.